President, thank you for such a kind introduction. I appreciate it. And thank you to Deborah and so many NACD members for joining us for this time-honored tradition. It's my pleasure to welcome all of you again, this time to the 35th Annual Spencer Fox Eccles Convocation. I remember that first one. I was younger then. Earlier this each year I reflect on the extraordinary legacy of my grandfather. You couldn't hear me? You heard me at dinner last night. I reflect on the extraordinary legacy of my grandfather, David Eccles, and the vision of my Aunt Emma Eccles Jones, who I assisted in her generously creating the endowment that continues to enrich this school today, the school that's named after David Eccles. Earlier this month, we honored the memory of my grandfather by unveiling the statue of him on the Emma Eccles Jones Plaza right outside this building. And I hope that you'll take time to visit the statue. It represents David as an impoverished, holes in his trousers, but determined 14-year-old boy, an entrepreneur even then, selling his father's hand-carved kitchenwares to help support financially the family after they immigrated from Scotland in 1863. Glasgow and Paisley. The spirit of hard work and innovating propelled him to build and to lead more than 54 businesses across the Intermountain West by the time of his death at a young 63 in 1912. We hold convocation every year to honor David's legacy, entrepreneurial spirit, business acumen, tremendous work ethic by hearing from outstanding business leaders who share those same attributes. So this year I'm thrilled to welcome my friend, longtime associate, Mary C. Daly, President and Chief Executive Officer of the Federal Reserve Bank of San Francisco. She, like David Eccles, indeed have quite a story to tell. Growing up in Missouri, President Daly dropped out of high school at the age of 15 and started working several jobs to help support her family. She went on to earn a GED, begin a career in economics, and eventually earn a PhD in economics from Syracuse University. Pretty impressive. She too brings her life experience to her work, remembering how critical economic opportunity really is for all Americans. Today, President Daly's work and research focus on employment and wage trends, economic growth, and economic shocks, topics that are incredibly important in the financial health of our nation. Her work with the Federal Reserve has a connection to our Eccles family legacy. My uncle, Mariner Stoddard Eccles, served as the 7th chairman of the Federal Reserve for 17 years under President Roosevelt. And he also ended up having the authority to write the Banking Act of 1935. And Randy Quarles, who is here today, has just completed his term as vice chairman for supervision for the Federal Reserve in Washington, D.C. And of course, I've known Mary for many years, working closely with her in the years following my time on the San Francisco Board of Directors. We're thrilled to have President Daly with us today, for sure, sharing her expertise with our students, faculty, and our business community. So please join me in welcoming our good friend, Mary Daly.
Well, thank you, Spence, for that kind introduction. When I first met Spence, we called him Mr. Eccles, as you might imagine. And the story I just told the students in a meeting with them before this event, it was really remarkable because I'm a rookie economist. Spence had finished his time at the San Francisco Fed head office board, and then he came to one of our big events. And in our big event, he saw me speak. And I was very nervous because it was a big group of people. I was a rookie. And he was the first person who walked up to me and he said, "Wow, you really have something. I have 3 daughters. I've invested in all of them. I've told them that you can be anything if you invest in yourself and you have confidence and you move forward." And it was, if you're, in business and other things, just remember it's that one phrase, that one time you walk over to a young person and you tell them, "I see you, I believe in you." It really was no small part of me ending up where I am today. So thank you, Spence. And then, of course, I've known Randy and Hope for a while, since Randy served on the Federal Reserve Board while I had been a Federal Reserve Bank president. So I feel really connected to the Eccles family, and I feel like I met all the other members I hadn't met before. So thank you so much for having me at this very important event. So I want to also say it's truly wonderful to be here in Salt Lake City today. Wonderful to be at the University of Utah. I'm honored to be speaking to such a wide array of audiences. I actually love a challenge, and today presents one. We have the 35th annual convocation where we have students, faculty, participants on the convocation. Then we have the Utah chapter of the National Association of Corporate Directors. That's really fascinating and exciting. And then we have broader Salt Lake City community members, businesses, et cetera. So why I think this is such an important group to bring together is it reflects the fabric of our state, of our nation. It has all the different components. The future that we have in young people, established businesses, people who are using their business sense now to go in and do corporate director work, establishing and helping other businesses. So this is just a really exciting time for me to be here, and I thank you so much for having me. Now, I come to Utah regularly because you're part of the 12th district, the 12th Federal Reserve District. And I last visited Utah back in April. And the new administration had just begun to provide details of its policy initiatives, and businesses and households were thinking, communities, they were studying, trying to figure out the impacts. So I would ask people before I came to Salt Lake, "What are you feeling?" And they said, "Uncertainty." Uncertainty becomes the word of the day. Worries about paralysis, stagnation, even recession started to dominate the news. The national conversation had shifted from confidence to concern. And then I landed in Salt Lake, the Salt Lake City airport. And driving through town, I saw activity, lots of it. Full parking lots, busy retail outlets, and most notably, cranes. Not the birds, but construction cranes. Although I did hear that's Salt Lake's bird, or maybe it's the state bird. But see, cranes tell us a lot. They're a really important indicator. It's expensive to put up cranes, and it's expensive to keep them running for the business. Businesses only do it when they see promise in the future. Active cranes, and more of them being assembled right before my eyes, tell me that people are adapting, planning, and contributing in order to move forward. The world had changed. You could see it in the national press. Uncertainty had risen. You could see it in the sentiment surveys. But it did not mean stasis, at least here in Utah. So that dynamic, the ability to move forward, even when there's uncertainty and even when the world is changing, is the topic of my remarks today. How to steadily keep going in the face of change. Now, if you've been to any Federal Reserve talks, you know that before we go any further here, we have to go and give you the reminder that the views I expressed today are my own and do not reflect any other member of the FOMC or anyone else in the Federal Reserve System. So let me step back and say, you notice I said steadily moving forward, not heedlessly, recklessly, haphazardly, but steadily, taking time to consider the situation, assess the risks and the opportunities, and plot a course that works in the evolving environment. Now, it turns out that that's exactly what businesses in Utah had done. As I learned during my visit, did my outreach, talked to businesses, they told me that they had stepped back. They had taken a moment. They didn't just keep going on the cranes. They had taken a moment. They had evaluated the changing landscape, and then they decided to keep the cranes running and continue to put them up. Their decisions were purposeful and intentional. So the question you might be asking as students is, how do you make those types of decisions when uncertainty and change is all around you? Well, the first thing you do is you know your goals. If you're working on a degree program right now, you can ask yourself, my goals, what are my goals? Are they building my skills and interests? If you're a corporate director for business, your goals might be expanding your market or building your product value. As a monetary policymaker, I'm focused on the dual mandate that Congress gave us, price stability and full employment. Your goals are your foundation, and they anchor. They anchor us so that we can keep tethered to our values and to our aspirations and focus on what is important in times of change. So that's the starting point. Now, with those goals in mind, you assess. Understand the change you face. Is it going to affect you directly or just your environment? Is it going to last? And what are the implications? Again, as students, AI is probably on your mind. You're asking about how it will impact your studies then and how you might change your career goals. What do you need to know and how might it shape what you do in the future? As corporate directors, you're likely studying AI, but also immigration, tariffs, taxes, deregulation, and a variety of other things that occur each day. As a policymaker, I'm considering all of those things and looking at how they might affect the economy today, but also the economy in the future. So this period of reflection, this questioning, this assessment, enables us to assess trade-offs and decide on next steps. It is not a passive state. You decide then to take more classes, put up a crane, change the interest rate. And then it all begins again. Anchor, assess, decide. I call that the virtuous cycle of remaining steady through change. Now, of course, especially if you've not done this before, you might wonder if it really works. Does steadiness really deliver reliable outcomes, ones that you're pleased you made? And I submit here that the proof is Utah. You can see it in the data. And it's not just because I'm here. I actually talk about Utah even when I'm not here, so just so you know. You can see it in the data. Utah is a national leader in growth and employment. It's a place where entrepreneurs take smart risks. Think Silicon Slopes, think the Olympics. These are not zero-risk events, but look what they deliver. And then countless other businesses and initiatives that are going on. I see Utah and the kinds of things that you as a state have taken on and city have taken on as just examples, a role model for the success of steadiness. Monetary policymakers must also practice steadiness, making reasoned decisions that support our mandated goals over time. Indeed, we've relied heavily on steadiness recently to navigate the changing economic landscape that has occurred this year and leading up to this year. As I mentioned, Congress legislated 2 monetary policy goals for the Federal Reserve: stable prices and maximum employment. No matter what happens to the economy, those goals are our anchor. So when I say return to our goals, that's what we're thinking about. All of our decisions are made in support of achieving those objectives and made on behalf of the American people. So the challenge, of course, is how to do that. How do we best get there? And I think that's especially challenging when the world is changing rapidly, when the economy is evolving each day, each week, each month, and we don't have perfect clarity about how the future will unfold. And that's where it's important for us to step back and assess. So earlier in the year, there was a lot we just didn't know. Measures of uncertainty were rising sharply. Households and businesses were worried about tariffs and immigration and whether that would rekindle inflation or slow the labor market and growth. Commentators and financial markets, they wondered whether the Fed would need to step in, either raising interest rates to combat inflation or lowering them to offset the chances of a recession. Up until last week, we did neither. Instead, the FOMC, the Federal Reserve, looked at inflation and how much it exceeded our price stability goal, because we had not achieved it. We saw how far away we were. We looked at unemployment, a reasonable measure of the health of the labor market, and how close that was to our maximum employment estimates. We considered the administration's emerging policies, consulting history, thinking about models, looking at scenarios, and looking at the data, just to understand how they were already affecting the economy and how they might affect the economy going forward. And most importantly, and I think that most underappreciated thing that we did, and that we do regularly, is we talked to people. We talked to consumers, workers, communities. We talked to businesses, small, medium, and large. And we asked them not only how they were feeling, but what they were doing. And what we determined in all of that was that the economy was doing okay, not just in Utah, but nationally. We didn't have to race in and plow ahead to make a quick decision, but we did need to continue to monitor the risks. So risks were on the horizon, but there were also positives. So you could think about, oh, maybe inflation will go up, maybe the labor market will slow, but there's also growth happening. And some of the reforms to taxes and deregulation can be positive for growth. So we have to think of all of those things and then look at how they affect the conditions and how those conditions are evolving. Most importantly, it was really important, and I saw a couple nodding heads when I said inflation was above target. It was really important throughout this year, remains important, for us to remember that inflation is above our target and that we made a commitment to restore price stability. So we had that top of mind. And in all of that assessment, we decided to leave the interest rate unchanged, keeping policy modestly restrictive, continuing to put downward pressure on inflation, and actively watching the labor market for any signs of stumbling, any signs of stress. Now, again, deciding to collect more information, to wait and collect and study, is not a passive state. It's not a passive activity. It is prudent preparation, and one that takes a lot of time and energy that you all will have to put in too. You really have to put the energy in so that when the time is right to take action, you're ready to do so. You know what to do. So for us at the FOMC, that moment to decide to do something else came last week. At our most recent FOMC meeting, we lowered the policy rate by 25 basis points. And that's a decision I fully supported. When you look at the incoming information and the data, it's clear that growth, consumer spending, and the labor market have slowed. And that inflation, while it's still above target, hasn't risen as much with the changes in tariffs and immigration even, as many expected. And so we have an opportunity to balance our two goals. The risk to the economy had shifted, and it was time to act. But importantly, acting that one time doesn't mean you know what you're going to do all the future times. Managing change is not a one-time event. You must keep at it. So moving forward, we will do the same evaluation to understand what it is before us, what the risks are, how they will shape out, and then importantly, make decisions. Now, my own view is that further policy adjustments are likely. Will they come right now, this year, or going forward, it's hard to say. But what's really important is that making those policy adjustments will likely be required to balance both of our goals. Keep pressure on inflation to bring it to price stability and offer support to the labor market to ensure that it stays near full employment. You can see this if you look at our projections. I will say, with the students, it was amazing how many of them had fantastic questions about the data and the evolution of our policy. So I'll point everybody to the same thing I pointed the students to, which is you could look at our summary of economic projections, and you can see how the evolution of the cuts in interest rates could come. But I want to make sure everyone in here knows projections are not promises. They're just outlooks given the information you have today. And what's important is you come back and you do that evaluation. You anchor on our objectives, you assess the trade-offs, and then we decide again and again. So now I'd like to just return and end with where I began, flying into Salt Lake City this April. On the ride over, I caught up on the news. The news was very pessimistic, worried about change, nervous about uncertainty, the national news. And the cranes that I saw told me something different. So if you're starting in your academic year, as I know many of you are, I want you to think about cranes. Remind yourself that change and uncertainty are normal parts of life, and that people move through them all the time. But you cannot leave it to luck. Being studied through change takes intention. It takes practice. And most importantly, it takes commitment. Commitment to your goals, commitment to collecting the evidence, and commitment to deciding. If you do those things and you remain humble enough to do them again as the change evolves, then you'll be ready and well positioned for whatever comes your way. In my view, and I'm doing this in my view, this is the success of the Eccles family and the heritage that we're standing here honoring. This is the success of the businesses that NACD represents, and this is the success of Salt Lake City and Utah. In my mind, this is the foundation of your success as young students, focusing on what you'll do next. Thank you very much. Thank you.
Well, great remarks, Mary. I thought you really did a great job of capturing the spirit and the essence of this place. By the way, for many of you I know, some I don't, Kurt Dirks, Dean of the David Eccles School of Business. I came here last year, my first year, flew into the airport and had that same feeling with it, which really the energy of this place is amazing, and it's really inspiring for us. So I think you really nailed that. I also felt it coming into this business school building because we measure that energy partially not by cranes, but by the number of students who are walking in our doors and their energy and optimism. And this year, despite the uncertainty, we have more students than ever, and I feel their optimism, and you heard the questions that they had for you in there, so I'm really excited about our future here also. What we're going to do now is do a fireside chat. We're going to get into a few of these things in a little bit more depth. And for we'll take a few questions from the audience in a few minutes. And then those of you, I know we're broadcasting this online. For those of you who are online, feel free to type in those and we'll take some of those questions. So I'm going to start in a few minutes with just some of the questions we have from our business community, NACD, and from our students, and then we'll go from there. So I'm going to come on over and join you here. And I've got note cards, so pardon me as I get the questions right. So you talked a little bit about your thoughts on the rate cut, which I think was very helpful. One of the questions that people wanted to hear a little bit more about is how the labor market is. So you're a labor economist, obviously know this very well, and people are paying attention to the labor side of that dual mandate that you have. One of the questions is the labor market weakening at a concerning rate, or how do you see that? How do you feel it from what you're hearing?
Absolutely. So, if you study labor or the economy long enough, you start using very specific words to mean things. So I wouldn't really characterize the labor market as weak.
Okay.
The unemployment rate is low, especially in many states like Utah, very low. The people are finding jobs. There's, wage growth is still expanding at productivity plus inflation. So you have a sense that people are moving and doing things. But what is true is that it's not as speedy as it once was. So if you think 3 years ago, it was what we called frothy, then it got to healthy, then it got to solid. Now I'd say it's sustainable, but I do not want to see further softening. So one of the things that you see in the rate cut is some insurance. You see the labor market has softened at a pretty good clip. It's come down rapidly from its highs. But the level of where it's sitting right now isn't weak, but you want to prevent that weakness because we know historically, once it tips into weakness, it's extremely hard to get it back out. And so we don't want to get in a state of weakness, and that's part of why the interest rate decision was very straightforward. You're taking out some insurance, as the chair said. I think that's a good way to think about it. You're basically giving yourself a little support for the labor market to maintain its health while you're continuing to bring inflation down to our 2% target. But that is something that's top of our mind. My mind is let's get the risk out of the labor market so that we don't end up with a softening to sustainable that comes through sustainable and ends up in weak.
Oh, that's great. Well, let's talk about that other side of that dual mandate then, which is related to inflation and prices. Here's a question from our business community. Given the recent inflation data and employment reports we've been seeing, how concerned should we be about the potential of stagflation in the current economic environment?
So this will be a test of your willingness to share your age, but there are people among us who have lived through what we thought of as stagflation, and this is not that. So stagflation is traditionally thought of as something that's like a much higher inflation number. Let's just pick one, 7% inflation, 7% unemployment, growth in the economy that's well below what we are potentially able to grow at, so say 1%, less than 1%. It's a sense that we're stuck in the mud. We aren't stuck in the mud as an economy, and so I don't see stagflation as around the corner. What I do see is that inflation's been printing above our target for quite a while, and that people have been enduring that sense that prices are rising, they're rising at a faster clip. When I get up in the morning, I still have to think about price increases, and we have work to do there. On the labor side, we just talked about this. This isn't a weak labor market. It's just a softer one, and we don't want it to get weak, so we have to give it some support. But really, people are still finding jobs. The unemployment rate remains relatively low by historical terms, and inflation is not 7%. It's around 3%, and that's with tariffs. If you take the tariff sectors out, inflation's roughly 2.4, 2.5%. So we're getting much closer to our 2% target. So I'd say that's an economy that still needs monetary policy, bridling, but not as much as we had. But it's not something that I see as faltering. And recession risk, I just looked at the recent statistics, again, coming over on the plane. You get a lot done on planes. But the recession risk is very low right now. Businesses and consumers, they don't see recession as around the corner. They don't really even see stagflation as around the corner. But it does make the news a little bit. But again, I would remind people stagflation is a very different thing. And if you want to read about inflation and stagflation, you can go back to the 70s.
While you're on recession, which was one of the other questions that came up from a lot of people, what should we be looking at for indicators if we might have a recession in the future? How would our audience think about what might be indicators of that's going to happen?
So one thing that we know is a reliable predictor of a recession in the next 6 months is a labor market that has rapid increases in unemployment. So if you see the labor market, having, every month the unemployment rate goes up, and you see the duration of people searching for jobs, unemployment duration go up, that usually predicts that you're going to have a recession as measured by the National Bureau of Economic Statistics. But we want to just not economic, NBER, research, economic research. I've got BLS on my mind because the students asked me about the Bureau of Labor Statistics earlier, but the NBER is the official dating committee for recessions, and you can put those together. I would offer, though, if you're thinking about monetary policy, by the time we're in a recession, unless we've had a shock that's pushed us in there, it's really late. We could respond, of course, with our policy tools, but we are working very hard to bring the economy to price stability without unnecessarily injuring growth of the labor market. And that labor market is our mandate, so we want to balance those two risks. So I don't see recession risk as very high, but consumers don't see it as very high, and households don't see it as very high. Another thing you can look at is investment. So business investment. Businesses don't invest into an economy that's about to tip into recession. Business investment's been one of the bright spots in the year because consumer spending is slowed, but business investment has risen. And a lot of that's in technology and AI, but that doesn't matter what they're investing in, as long as they're out there and they're investing and they believe in the future. Then in those cranes, that's why I like to count cranes. I count cranes wherever I go. You guys might have the most cranes, really, but I do count them wherever I go. I count cranes and I count the ships in the port and how much stuff they're unloading and how much stuff they're loading. So it's a good leading indicator.
Oh, that's great. We have a lot of trucks coming into Salt Lake City.
No, that's
too,
another
which is a
one.
Great indicator.
Yes. Okay. Good.
Well, perhaps the word of the year is tariff, and so to what extent do you see increased tariffs impacting inflation? I believe Chairman Powell, said that the impact of tariffs are one-time and not persistent. How do you see that?
So certainly, economic theory and history would say that tariffs come, they change the price level. So if you're tariffing a shoe, you're going to pay more for that shoe, but it's only going to happen once because the tariffs are a one-time thing, and then you don't keep seeing the price of shoes go up. So in that sense, it's a one-time thing. But one of the things we've done as a committee, and I mentioned that we waited and assessed, is to see whether or not that theory would play out in the current economy. Because another thing you could worry about, and certainly we did think about, is could it spill over? Could people see that the price of shoes has gone up, and so now if you're a barber, you want to raise the price of haircuts because you get on the price increase train. But we really haven't seen that. We haven't seen tariffs impact inflation in any sector other than the directly tariff sectors like goods and only the tariffed parts of that. And then in services, you haven't seen it gone up. And in housing, where they have many, many inputs that are tariffed, you haven't seen the cost of housing rise rapidly. In fact, shelter inflation's been coming down, not going up. So that's, I think, evidence so far that's consistent with tariffs being a one-time thing. Now, that doesn't mean that it's not something that consumers have to deal with. But again, on tariffs, a thing we didn't know is whether consumers would bear the entire burden or whether some of it would be passed through to the different parts of the supply chain. So I remember in April, I was talking to some business leaders at a roundtable here in Salt Lake, and they said, oh, we're not going to pass it all on to consumers. In a world where consumers were not in the situation they were in, you might be able to, but right now consumers have been picky, they're worn out from the high inflation we've already had, so we're going to try to split it, give it a little bit to the importing country, take a little bit at every little turn, and then by the time you get to the consumer, the inflation impact is just lower, and we're seeing that, right? If you look at the announced tariffs, the tariff revenues, they have not come into consumer prices because people take them along, firms take them along the supply chain, and everybody shares a little bit of that or spreads it out over a longer period.
That's super fascinating. In Utah, we have a interesting challenge because we're growing so much around housing affordability. And it's a major concern here in Utah and for our future. Current interest rate environments disproportionately affecting first-time home buyers and low-income households. So I know the Fed does not deal with housing policy, But how do you analyze the increasing cost of housing as you formulate policies and you think about your role?
And I'll just start with what you mentioned. I mean, we have one tool, the interest rate, and we have two goals, price stability and full employment. And we make interest rate policy for those goals, but also for the whole nation. And so one of the challenges is when you make those changes to bring inflation down, it can affect sectors like housing. But over time, getting inflation stabilized actually helps with house price appreciation. So the thing that I think is really important is this is not a Salt Lake City or Utah situation just. So there's a group in Washington, the Cato Institute, and they did a survey. I'm really just talking about their survey. It's quite nice. It's now a little bit, I think it was done last year, but it was really helpful in this regard. They did a survey across the United States, and they asked people, what is your number one concern? And housing affordability was the number one concern. Then they said, well, let's break it down by geography, wealth, income, sector, age, political party, and everybody shared the same concern. And then they did some looking into it, and they said it doesn't matter whether you're a first-time home buyer or you've got grandkids and you want your grandkids to live closer to you, so you want your kids to move back near you, or they can't afford the neighborhood. So, and people can't downsize because they can't sell their home into an environment where people can't afford it. So what is happening? The answer to what is happening, if you're a home builder, you know this, is that home supply, the supply of homes available for sale, is less than the desire to have homes. Supply and demand are completely out of balance, and that imbalance has been growing since the global financial crisis, when the housing market really got hurt. It was the starter for all of that, and builders became very focused on not getting into that situation again, and as a consequence, we have too few homes for that population that's been growing, and so we have this imbalance. So, what do places do? And I'd say that Utah, I mean, I've seen a lot of housing out there. There's a lot being built. You just drive from the airport to downtown, and you see, I mean, I've been coming since 1996, and that was just open area. Now it's, it's housing. But this is something that you see going on in other parts of the country, and where I see the most possible solutions is in public-private partnerships, where and civic leaders, where civic leaders say, okay, let's think about zoning, where private sectors say companies say, let's invest in this because we need workforce housing, or else we don't have our workforce near where they need to live. We have community sectors, which have mostly been focusing on affordability issues for the very lowest income. I think we now have to go all the way up the income distribution and say, we just need more housing. So I'll leave you with this, which is a national statistic. Back in the early 60s, and the numbers change depending on how exactly you do this calculation, but the direction is right. Back in the early 60s, 60-something% of homes, the majority, were available to first-time home buyers. The price point was low enough that a first-time home buyer could afford one. Today, it's closer to 13%. Wow. So that's also about the types of homes we build. If we build larger homes, they have higher price points. If we build smaller homes, they have lower price points. So somewhere getting that balance right, involving home builders, involving civic leaders, involving the private sector businesses, I think that's where we're going to need to go. But it's a national problem. The interest rate will help a little bit, but there's not enough relief in interest rates if we just bring them back to neutral even that would cause this to change. It's really about the dynamic of the situation we found ourselves in that started all the way back in the aftermath of the global financial crisis.
So that is a fascinating statistic, and something that we'll see what we can do about. And next month we're going to have with Ivory Innovations here in town, one of our home builders is going to have a summit on thinking about how we can address this. The governor will be here, so I know we have a lot of people thinking about this.
And Clark Ivory is one, he was a former Salt Lake City branch board member, and we keep in touch with him quite a bit to talk just about this issue. So that's an example, the kinds of things that you all are doing that I think I use when I go other places and say, where could you start to make a dent?
Awesome. Let's see, we're going to turn to the audience in just a minute. I'll have a question related to students. You had a great session with students, a lot of great questions. I know we have a few more in here, so I'll ask a related question so other students can hear and our entire audience can hear. You have one of the most amazing stories about dropping out of high school to support yourself, your family, getting a GED, going on to college, and here today, you are sitting here as the CEO of the Fed. Any thoughts about that journey along the way that will be helpful to our students and other people who are striving to make that climb? Any advice for them?
Yeah, sure. I think about this a lot, and I mentioned Spence right at the top about how he put something in my mind, said something to me, took the time to build something. If you're just starting out, whether you're starting a business or you're starting in your academic program, et cetera, and it's new to you, it's foreign, you're not going to feel perfectly comfortable. And the thing that gives you comfort is reaching out to other people. I didn't go to college because I was, sitting at my house one day and said, I'm going to go to college. I wanted to be a bus driver because I was working 3 or 4 jobs, driving donuts around and working at Target and doing various things. And I just wanted one full-time job. And I saw a billboard every time I drove the donut truck that said, become a bus driver. Good people, good pay. And I thought, well, that's a good future. So I'm talking to this woman named Betsy. Betsy Bain, my mentor, says to me, well, you cannot be a bus driver unless you have a GED. And I was first deflated. And then she said, but let's figure out how to sign up and you get the GED. So I get the GED, and then Betsy being Betsy, and all of us have this power, by the way. When Betsy did this, I'm 16, 17, she's 32. So she didn't have to be 72, she was 32. So everybody in here has the power to help people along the way. She said, you should maybe get a semester of college. So I did. And then she said, you should go to a 4-year program, and I did. And then I went all the way to get a PhD. And I met so many other people along the way, like Spence and Randy, and many people who are here from my board of directors from different ports where, they start out, they know me. Deborah says, I know Mary from long ago, but they always had something positive to say. So if you're just starting out, your job is to take all those things in, grab hold of them, assemble them, and build your confidence. Because you're gonna have to practice your way to the types of things you ultimately want to do. And people along the way encouraging you are your ladder up. That really is a ladder up. I know if you're here, you're investing in skills and connections and learning your interests, but you have to invest in relationships with people who can give you the strength so that when you're in a moment when you're stressed or you don't know if you can do it, you think of them, they're by your side, and you go forward. So that's my advice to you. We're sometimes our own worst enemies in not taking in the positives that people say about us and using them as the ladder up that we need. So don't be an enemy of yourself, be a champion of yourself. Every time you get a nice thing said to you, put it in. I have what I call my virtual box of diamonds. And I just pull those diamonds out when I need them and I look at them. And if you're at a point when you can give diamonds freely, please do.
I love both sides of that story, and one of the things I've discovered by being here last year, we have a lot of Betsy's here in Salt Lake City and who are members of this school, and I think that's an awesome thing, so be a Betsy out there if you're not yet. Well, let's take a few questions from our audience. If you raise your hand, one of our staff members will bring you a mic. So we have a question over here and one down here. So Michelle, if you can grab one.
The lights are bright,
They're
right?
very
I know,
bright.
I feel like I need my baseball cap.
Yeah, I always like to ask this of every leader, and you're talking about mentorship. What's a book recommendation do you have for us?
Book recommendation. So I read a lot of different books, but right now I'm not reading a book that would inspire. I'm just reading a book that I enjoy. Maybe it'll inspire me. So I like this author. Now I'm going to be plugging him, but I like this author, C.J. Box, who writes these mystery novels as a park ranger. Or he's not really a park ranger. He's like he's is he a park ranger? But he does wildlife. He's out there checking things in Wyoming, and I like doing that. Why do I like doing that? So maybe this is my advice. Instead of a specific book to read, my advice is read a book. No, seriously. I have reams of information I have to read as part of my work. But I also pick up a book here and there, and it can be a nonfiction book, a history book, it could be a novel, and I give myself a little time to let my mind rest on my work. Because if you let your mind rest on your work, you come back with more inspiration, you can think about problems differently, you can approach things with a calmer sense. And so that's what I'm reading now. If you haven't read C.J. Box, I highly recommend it. I really enjoy his books. They, you know, my wife says they get repetitive, but she's addicted too, and now she's passed me up because she has more time to read. So I enjoy that. But I guess, you know, all the books I read are really helpful to me at stepping back and stepping away from the day-to-day work, and I think it's made me a better leader, a better thinker.
Great advice. Okay, we've got a question over here, Monet.
Hi, I was just curious how you are interpreting artificial intelligence when you're looking at the Fed's goal of full employment, and also is AI changing the interpretation of how the unemployment rate is acting on the labor force and economic success in general with AI accounted for?
That's a good question. It's a great question because it has many elements to it. So let me step back and say what our full employment mandate is. So, you know, the fiscal agents, our elected officials, they and your elected officials here in your area and private sector businesses, that's going to determine the size of the labor force, productivity, and all the policies we have. That determines really where the settling rate of the economy will be. The Fed doesn't do that. We manage the cyclical components of how the labor market fluctuates around that goal. So if we have a rapid rise in unemployment, then we know that all the people who are there available to work aren't able to get employed, so then we would think about adjusting the interest rate in order to support the economy to absorb those kinds of people. Help businesses be able to feel like they can take risks, they can, you know, pay the costs of the interest rate plus the business, and they can hire more workers. So that's that dynamic. We don't have a pen that says we can have more people in the labor market than the economy can provide, because it's really the nexus of business, how many people are there and interested in working, and then the policies that our elected officials create to promote that. But you're right, I do think about AI. At the San Francisco Fed, we have something called the Emerging Tech Economic Research Network, and we set it up in January of last year to study AI and generative AI and to ask the question, what are the outcomes on the economy? What's this going to do to productivity? What might it do to the labor market, and how will people fare? And so far, what I would say is that AI is not really taking jobs per se, it's taking tasks. And we have had for a while now, less so today, of course, but we had for a while now a shortage of workers able to do work. So the AI was helping businesses say, well, if I don't have all the people I need, I can make the 3 people I have for that role better because I can take less, you know, more tedious, more automatable tasks off their plate. But we have to continue to study this. The thing I will say about AI is don't be afraid. Right? Technology is not something to fear, it's something to leverage. It's a tool. And so the more you know, I have 5 AI models on my personal phone, and I use them every single day. I actually send the same prompt to all the models just to practice and see which ones do better at which things. And I try to integrate this into my daily work so that I understand what it's doing, how I can leverage it, and where it's not going to be beneficial. And I think that's what I would encourage you all to do, because if you have those skills, if you're an early learner, we call ourselves early learners in San Francisco, you know, we want to be early in the game, thinking and learning about something so that we can then go forward if that comes. I'd love history, so go back if you haven't read about the Luddites. The Luddites didn't like the Industrial Revolution, but it didn't stop it. And so the lesson really is that technology doesn't stop. It just can leave people behind if people don't pivot to harness it, right? It's not like I'm a person who thinks the machines are going to take over and then we're going to have nothing to do. I don't think that. But I do think that the time is now to throw yourself into learning things, and it may be something different 10 years from now. It might not be AI, it might be something else. And go back to when David Eccles was here. That's why I like history. You go back to when David Eccles was here. He didn't have a smartphone, didn't have the internet, I don't know if he had a car, maybe he had a car, but people were getting cars, maybe had 6 cars or trucks or things, but it was just like things that people have that they didn't have before, and they embrace them, and then good things happen. So I don't think it affects our statistics, our labor market data, or even what is maximally possible, but I do think it changes things in a way that we have to keep up with.
That's a great answer. I think we were at 3 o'clock, and so I think we're probably out of time for questions here. I want to do 3 thanks, though, as we wrap up here today. First, a thanks to the audience. I wish we could have gotten to some more questions today, but this will be a great discussion we're going to have outside right outside of here in just a few minutes, reception. Particular thanks to you, Mary. You had a great session with our students. I know that was super inspiring. I know you shared a lot of great information here today. Let's give Mary a great round of applause.
Thank you. Thank you. Totally my pleasure.
Awesome. And then the final call out, it brings us back to why we are here today, which is to recognize and celebrate and thank the Eccles family. You have been with us all the way here. 35 years ago, we named this school. We thank you, Spence, for doing that. We thank the Eccles family for being here with us all those times. We thank and appreciate that David Eccles, many years ago, came to this valley and provide inspiration that we still draw upon today. And then finally, I just want to call out how deeply rooted finance and economics is, not only here in Utah, but particularly here at the David Eccles School of Business. You heard Spence mention Mariner Eccles with the Fed many years ago. We honor him today with the help of the Eccles family at the Mariner S. Eccles Institute for Quantitative Analysis and organizations. And that today is graduating some of the best students that we have here at the business school and here at the University of Utah, as well as providing important insights for the economy here. So Spence and the rest of the family, thank you so much for what you have done with us, and we will continue to try to live up to that inspiration. Thank you so much. All right, thanks for being with us today. Thanks again. I know, as I said in the next Mary Daly is in our halls.
Absolutely.
And we are going to see them today. Please join us outside for a short reception.
Thank you, that was great.